Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me here in the studio is my friend and colleague, Niklas Sävås. Today we are excited to speak to Pieter Slegers. He is the founder of the investment newsletter Compounding Quality, and previously he has worked as a professional investor in Belgium. So, Niklas, which book will we speak about?
So in this podcast, we often speak about books that have been published years ago, but this one is actually hot off the presses. The Art of Quality Investing was published back in April, and as the title suggests, this is a guide on how to determine the quality of a business.
And what are your thoughts about the book?
So I think this book has been written in a form that makes it easy for the reader to follow and work with practically. The author presents a checklist in the second chapter that readers can easily go back to, and we get the input for a quantitative screener. And I also appreciate the fact that all sections of the book ends with a conclusion.
The Art of Quality Investing was published in 2024, and we are delighted to talk about the book on the show today. Here comes our conversation with Pieter Slegers. Hi Pieter, and welcome to Investing by the Books podcast.
Thank you very much for having me. I'm a loyal listener of the podcast, so being on the other side of the table is a true honor, and hopefully we can have a nice conversation.
We're delighted to have you on, and thank you for taking the time. Last time we met was in Omaha last year. Where are you today?
Exactly. So last year we met in Omaha. This year, or right now, I'm in Belgium, near Antwerp. So that's where I live. And obviously, the Berkshire AGM is approaching once again. So also going there in a week from now. So happy to meet a lot of listeners and other interesting people there.
And to begin, can you tell our listeners about your background and where your passion for investing started?
Sure. So most of you will probably know me under Compounding Quality, but my first name is Pieter. And just like many of you, probably been interested in stocks for a very long time. So started at the age of 13, basically made all the mistakes you could possibly make. So at the age of 13, I had no clue what I was doing, put all my money in one stock, no diversification, just followed someone else's idea, basically. And you can imagine the end result. Well, it was horrible, my first investment. But yeah, to me, that was one of the best things that could happen to me, because when that happens to you, you have two choices, right? You decide to say that investing is nothing for you, or you really try to read books and educate yourself. So that's what happened to me. And that's when I really started to get interested in investing, reading a lot of books and so on. So that's also why I studied financial management in Belgium. Worked for 3 years in the industry, so in the asset management industry. But yeah, two things, I guess. As a kid, I always wanted to become a teacher on the one hand, and the other hand, well, I always wanted to start and work for myself. So that's why Compounding Quality started. And yeah, it started just for fun to post some things about the stock market, your thoughts and so on. But it has grown way more than I expected, and that's what I'm doing full time now, and that's also why The Art of Quality Investing, the book, was published.
And today we will speak about the book, The Art of Quality Investing. How did it come about, and what has your role been?
Yeah, so sure. First thing to mention, and obviously credits to those who deserve. So Luc Kroeze, I worked together with Luc Kroeze on this. He's a great friend, and he basically wrote the book, The Art of Quality Investing. But I always laugh with him, well, what Benjamin Graham is to Warren Buffett, you, Luc Kroeze, are to me, because he taught me a lot. And don't get me wrong here, I absolutely don't want to say that I'm as good as Warren Buffett, not at all. I'm only 0.0001% as good as Buffett, right? Because if you think that you can be as good as Buffett, well, you should read the book, The Snowball, and think again, because it's really phenomenal. But yeah, Luc taught me a lot about quality investing. He wrote a book in Dutch, and we decided to work together on this one and to publish it under Compounding Quality with The Art of Quality Investing, because we felt like, obviously, a lot has been written about value investing, like the books of Benjamin Graham, right? Or growth investing, the books of Phil Fisher and so on. But there aren't that many books about quality investing. And yeah, it was Charlie who said, well, books are a beautiful thing because sometimes their answers were billions of dollars in a $30 history book. And I guess what the book tries to do is, it tries to, at least for Luc and myself, outline the entire quality investment philosophy from A to Z. So yeah, what is quality investing? How can you find these kind of companies? How to think about valuation, because obviously these companies are sometimes somewhat expensive, at least. How to build a portfolio. So the book tries to give an entire framework about the quality investment philosophy, basically. And that's also what compounding quality is doing. So basically the book is more the theory about what quality investing is. And then you have compounding quality, the website, which is more putting the theory into practice and portfolio investment cases and so on.
And can you tell us a bit more about Luc and how you got in touch with him from the first place?
Yeah, it's basically also a funny story, because when I was still a few years younger than I am today, at least, I joined the asset management industry, and I would consider myself as a value investor. And basically my entire portfolio was, it's not a proud thing to say, right? But basically almost my entire portfolio was invested in Belgian companies. So suffered from a lot of home biases. But when I joined the industry, for the company, the asset manager that I worked for, well, we basically weren't allowed to own any Belgian companies. Now, what's the reason for that? When, for example, the Belgian stock market isn't that large. And what you could do in theory is, for example, you could buy a Belgian company for your fund and buy it in advance for yourself, and then the buy of the fund would influence the stock price, and the other way around. So it's front running, that's illegal. So I needed to sell my entire portfolio and rethink my entire investment philosophy, because also the companies I knew well were the Belgian ones, but I didn't know many companies internationally. And that's when I got into quality investing, so reading a lot of books, reading everything of Terry Smith and so on. And Luc has always been a quality investor, basically. And we just started talking, and then probably for a period of 3-4 years, we talked daily about the investment philosophy. And yeah, that's how our friendship started. So we worked together on the book, but I would definitely say that we are friends. And just also in general, being able to talk about investment ideas with other people, like what Warren and Charlie did, for example. It's a true blessing to have someone on the other side of the table, and when you have an idea and you propose the idea to the other investor, that he can, for example, break it down in 10 seconds. Well, that saves you a lot of time, saves you a lot of more work, and having someone who is critical and having someone to just share and discuss investment ideas with is something beautiful, I guess.
And many authors that we speak to and read about, they have a person in mind when they write a book. Who did you write the book for?
Obviously, credits to Luc, obviously, but I guess indeed that it's always important to have someone in mind. And how I can answer the question is, for example, I write a newsletter. Who do you have in mind? I always try to have Warren Buffett in mind, in the sense that also it's a pity because it's at my office. I also have a poster of Warren Buffett and Charlie in my office. But just to remind yourself when you write or when you analyze a stock with Warren in mind, for example, to constantly remind yourself of the fact that I want to generally do the right thing. And is this a company that Warren would look at? Or, for example, from the ethical point of view, well, would this be something that Berkshire would do or not? And this already allows you to kill a lot of investment ideas really fast. So I guess, definitely in the industry, honesty and integrity, open communication is something really, really important. So that's also what I try to do with Warren in my mind. And also, for example, that's also what I felt like in the industry, for example, the investment industry. You have a lot of professionals, for example, who manage several hundreds of millions. And they don't invest a single euro or dollar in the fund themselves. So that's something, that's really odd according to me. So also having skin in the game, put your money where your mouth is, something really important. And once again, and apologies if I'll do it too much, this podcast, but Buffett quote, well, it takes years to build a reputation and a few seconds or a few minutes to ruin it, right? So if you think about that, you will handle differently and communicate differently to your readers.
I think you were very successful with this book to achieve that. I mean, it really does a great job in explaining key concept in a very good way. And as we said, it's focusing on quality investing. So if you would describe this in the shortest or crispest way as possible, how would that sound like?
Yeah, so for me, I would just say in one sentence, well, quality investing is about investing in the best companies in the world. And we all know the quote from Warren Buffett, well, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that's exactly where the entire investment philosophy is all about. So when I need to summarize it in 3 steps, and it's based on, once again, Warren Buffett on the one hand, and then Terry Smith from Fundsmith on the other hand, it's one, buy wonderful companies. So companies with a healthy balance sheet, high profitability, low capital intensity, and so on. Then you want to buy those wonderful companies led by excellent managers. So managers with a strong track record, skin in the game, and so on. And then obviously wonderful companies, excellent management. The market often recognizes this. Then it's the art to pick up these companies at fair valuation levels. So wonderful companies, excellent managers, and fair valuation levels. That's basically a 3-step process you can use to try and find those kind of companies.
I really love the quote, you don't ask a bird which wing is more important. Both are essential to fly, describing that both qualitative and quantitative factors are crucial in determining quality. And starting with the qualitative factors, which chapter makes up nearly half of the book in total, you list 9 overarching criteria, and we would like to dig a bit deeper into the factor that the companies, a quality company should operate globally. What is the reason for that criteria?
Yeah, obviously, well, the more diversified a company is, well, the less risk for you as an investor. So in an ideal world, you would like a company that is active in the US, in Europe, in Asia, and so on. Because when you do that, actually you reduce your risk as an investor, right? Same goes for client diversification, for example. When one client accounts for 50% of a company's revenue, well, that's a serious risk. Obviously, when the client falls away, well, it would seriously harm the business. And that's also, for example, let's say that a company has 1/3 of its sales in the US, 1/3 in Europe, and 1/3 in Asia. When then something bad happens in, let's say, Asia, well, 2/3 of the revenue is still in other regions, right? And that's something completely different, for example, to when a company is only active in Asia. And we see that all the time when you can offset this kind of volatility. That's a beautiful thing as an investor. So that's also what you want as a quality investor. You want to invest in really companies with stable revenue streams, really predictable. Because, rule number 1, don't lose money. And rule number 2, don't forget rule number 1. That's exactly what we are trying to do also here. And maybe one thing to add, well, quality investing is not about investing in the next big thing. It's investing in companies that have already won. So we don't want to look for the next Amazon or the next Apple and so on. The only thing you want to do here is to do slightly above average for very long periods of time. And you often do that by investing in well-diversified companies with very predictable revenue streams. So that's why we also want the great diversification from a client perspective, regional and so on.
And even if those companies you mentioned, they have global operations, but the headquarters is still quite important when it comes to the governance side. So are there any specific countries or parts of the world where you see a higher density of quality companies?
Well, for me personally, I'm a bottom-up stock picker, so I don't care too much whether a company is listed in Sweden, the US, Tokyo, or what might be the case. So what I might see today is, for example, that when you have 2 similar companies, and one, for example, I guess you guys are based in Sweden, right? Yes. Okay, that's correct. and when you, for example, compare a company in Sweden compared to one in the US with similar characteristics, you will often see that the company in the US trades at a PE of 25 times earnings, and maybe it's 17 or 18 times earnings in Sweden. So that's something to take into account right now, if you ask me. But I think the key conclusion here is just bottom-up stock picker and trying to buy wonderful companies at a fair price. And you also mentioned, indeed, sometimes it depends whether or where the headquarters of the company are, right? But what we see is, you have plenty of companies who are, for example, headquartered in the US or headquartered in Sweden, but they generate revenue in maybe 100 countries. So obviously, sometimes these companies hedge their foreign currency risk. That's also a very common question for members of Compounding Quality. You have companies, for example, invested in obviously US companies like MedBase, but also Kelly Partners Group in Australia, even a company in Poland, and so on. And a lot of questions are about, do you hedge the FX risk, sort of foreign currency risk? How do you think about that? But in the long term, well, Peter Lynch said it, well, if you spend 30 minutes a year on economics, you wasted 10. In the long term, well, one, you have no clue about how, or at least I have no clue about how foreign currencies will evolve. And then also when you have, different kind of foreign currencies in your portfolio, I just have the opinion that sometimes you will win, sometimes you will lose, and sometimes you will win because of foreign currency movements, and sometimes you will lose. But in the long term, they will more or less offset each other. So it's not something I'm worrying about right now.
Yeah. Something that I think about sometimes is the identity of a company and also the people working there. For example, you meet someone in a subsidiary of an American company, maybe here in Sweden or in Germany or in Belgium, and they feel like, oh, but I belong to this American company. Okay, you're operating in another market, but still you're kind of, it influences you in a way. And, oh, I work for a Chinese employer. Or how does that impact me? Is that something that you think about as an investor sometimes?
Well, what I would say on this one is that obviously I think the culture of the business is so important, and it's hard to measure. But, well, what we can say is in the short term, so let's say a period of 1 year, the momentum, so the momentum and changes in valuation drives stock prices, right? Then in the medium term, it's more the earnings growth, the free cash flow growth, and so on. But in the long term, it's really the culture. And that's also why I think that skin in the game is so important. So, for example, what you love to see is you have a US company in HVAC, Watsco, where around 50% of their employees are shareholders of the business. That's something you love to see. So you want a culture where everyone within the business thinks and acts like a shareholder, and where they're there to make decisions that might maybe harm short-term results, and might even loss-making investment in the short term and so on, but that create a lot of shareholder value in the long term. That's something you really want to see. So when you would make a list with companies with great culture, and probably, for example, Thorndike's book, The Outsider, it's an excellent read, right? Those kind of companies where you just would look at the track record, that's something really important. And that's maybe also something I wanted to add about the quality investing philosophy. Yeah, wonderful companies, excellent managers, fair valuation, but maybe even there should be a 4-point, companies with an excellent culture. And you're thinking about Kelly Partners Group in this case, Watsco, you have Danaher and so on, where everyone really thinks like a shareholder. And that's something you love to see.
So related to management and skin in the game, as you mentioned, that's one filter to see an excellent management. What else is there for you to evaluate if you have a good team at the top?
It's a tough one to look into, right? Probably, obviously, what is the most important task of management? It's probably capital allocation. So what you can do to evaluate management is just look at the historical capital allocation metrics, how they evolved over time. And obviously, when, for example, the capital allocation has been really well over the past few years, and the manager or the same CEO has been doing it for years, that's obviously a great sign. So what I'll always look for is you want to return on invested capital larger than 15%. And obviously, when a company has great capital allocation skills and they have plenty of reinvestment opportunities, that's where the magic happens for quality investors. That's how compounding machines are created, as Chuck Aker called it. And it's a really important one because also obviously when you have a traditional company, often when someone becomes a CEO, they become the CEO because they were great at marketing, because they have the best technological skills within the business, they are great in sales and so on. But then they become the CEO, but basically they have no experience in allocating capital at all. And if you ask me, that's something that's dangerous. That's also what separates the outsider companies, for example, to regular companies. So what I always look for is obviously a very strong track record of management. And when you see that, for example, let's take Medpace, August Schroeder founded in 1992. And since then, the company performed really well. So August Schroeder is the founder and CEO still today. So he's been doing it for more than 30 years. The track record has been excellent. He has a net worth of 2.3 billion, and 2.2 billion out of that money is still invested in the company. In that case, you know that at least he is doing something well, right? So as a quality investor, probably being really strict. So you are excluding basically 98% of all listed stocks because they don't fit your criteria. And obviously, sometimes you will, quote unquote, throw away a lot of good companies with that. But the most important thing, or at least to me, it's not a problem that you exclude good companies. But the most important thing is that the companies that remain are doing quite well or should do really well on average. So the skin in the game part is really important. And probably for me, 70 to 75% of the portfolio is invested in companies that are still run by the founder or family business, because it's hard to measure the integrity of management. But when you know that he's in there with his own money and that almost all his net worth is invested in the company, well, I think you increase your chances that incentives of management are aligned with the ones of you as a shareholder.
And at Redeye, we have a quality rating as well, where we really go into the companies. And this one, we consider the board of directors and ownership structure of a company. We have some questions about that. And we didn't find that in your book. Is there a reason why you don't focus on that part so much?
Yeah, obviously, I guess the book is 207 pages right now. So you can't talk about everyone. And the main goal for the book was that people who are still starting with investing can understand it and it's handy for them, but also for more novice, more experienced investors that it's handy for them. But obviously it's a very important thing, and I also love the rating of Redeye. Obviously, I've also read your book, or the book Redeye published with Björn. So important one for sure, and maybe for our next book, who knows?
And I'm a bit curious to know more about, I mean, in of the qualitative factors, you have decided to split the section between moats and disruption. Mm-hmm. And I'm just curious to know your reasoning there around why you don't necessarily think that a wide moat is supposed to defend the business from disruption. Or if you do, just clarify maybe.
Most important thing I would say here, I guess, is that to me, a moat is never constant. So in other words, a moat is shrinking or widening every single day. And obviously a moat is the most important thing for quality investors probably. How do I look at it, for example? Well, you want pricing power and a high and sustainable return on invested capital. But then obviously disruption to me is the worst enemy for a quality investor. Because we all know the example from Kodak, for example. Kodak was the clear market leader 25 years ago. Yeah, people talked about the Kodak moment as taking the perfect picture, right? But then they didn't invest in the digitalization of taking pictures. And they basically, today Kodak is only a fraction of what it is today. That's completely different to, for example, Amazon, who evolved from an online bookstore, a loss-making online bookstore, to the largest e-commerce company in the world, right? So one conclusion you can draw here is that, a company should keep innovating all the time to remain successful. But also that, for example, when a company has a moat in a rapidly changing industry, that can be a dangerous thing. So what Warren Buffett, for example, said, well, in 10 years from now, in 20 years from now, I know that everyone will still be drinking Coke, going to McDonald's, brushing their teeth, drinking coffee, and so on. But I'm not sure how the market for cybersecurity will look like, how the market for AI will look like, for example. And to give you an example there, for example, I looked at Fortinet. So whether it might be interesting to invest in Fortinet, the fundamentals look good. It's a secular trend. Obviously, cybersecurity is growing fast. I also think the company has a moat, so a competitive advantage. And disclaimer maybe here, I didn't buy the company because I thought they were too expensive. And obviously, they're also using a lot of stock-based compensation. But key point here, well, I think the company has a moat. But when you look at disruption, I have no clue, and I'm not a cybersecurity expert. Maybe some listeners are and can make a better case here. But I have no clue how the market for cybersecurity will look like in 10, 20 years from now. So that's why moat and disruption you can make the separation. So first lesson, a company's moat is changing every single day. And obviously the company should work on try to widen it every single day. And two, a company should always keep innovating to fight against disruption. And for you as an investor, probably the best protection against disruption is to invest in companies that are active in very slowly changing industries. So once again, investing in the next big thing can be very tempting, but investing in quote unquote boring companies and trying to not make big investment mistakes is probably one of the most important things. So many investors focus on maximizing their returns, but minimizing your downside might be as important or even more important than maximizing your returns.
And in the book you write that the margin of safety that you prefer is the value of the company's competitive advantage. So how do you estimate the margin of safety in a moat?
Yeah, so most listeners will know the Benjamin Graham's margin of safety, right? So the margin of safety is in the cheap valuation level, and the cheaper you buy a company, the higher your margin of safety. Well, for quality companies, obviously wonderful companies led by excellent managers, often the market also recognizes this. And in this case, indeed, so the market recognizes this, so the valuation is at least a bit higher. And what you see in this case is that indeed the margin of safety is in the moat. Why? When the company has a competitive advantage, so they are doing something unique, other rivals can take market share and so on. What we will often see, and we are often, for example, or many people are executing a classical discount cash flow model. And take Microsoft, for example, you indeed do this for 10 years. But what you see with a lot of quality companies, take Visa, MasterCard, S&P Global, Moody's, and so on, they can grow at above average rates or at attractive rates for way longer than 10 years. S&P Global has been doing it for 20 years. They also have pricing power and so on. And obviously, when you would make a discount cash flow model and not taking or not making assumptions about the free cash flow for the first 10 years, but you would do it for 15 years or 20 years, almost every company would be undervalued, basically. And that's exactly what's happening with these kind of quality stocks. So they can keep growing at very attractive rates for very long periods of time because they have a moat and because other rivals or other competitors can take market share. And that's a really attractive characteristic for them. And when the company can keep its moat and they are active in an attractively growing end market, well, beautiful things can happen. So for quality investors, the longer your investment horizon, the longer you keep a company, well, the less valuation matters and the more important the growth of the intrinsic value per share growth becomes. And I'm not here to say that valuation doesn't matter at all, because obviously it does. But that's why we state wonderful companies at a fair price. So you try to find companies that can grow their intrinsic value at attractive rates for very long periods of time. And then you try to not overpay for them. And when this is the case and your homework is correct, well, the best time to sell is probably almost never. And that's one of the attractive things about the strategy, if you ask me.
And after the chapter on qualitative factors, you have a chapter on quantitative factors, and you have gone into a few of them already. But as you write in the book, while the quantitative factors tell us about the past, they are of course also an important lead for the future. I'm curious to know what metrics you think are the most important for a quality investor.
Yeah, obviously. So we already briefly touched upon some metrics. I think the return on invested capital, it's definitely a really important one. So personally, I always wanted to be higher than 15%. And some people who are, have some expertise in the field, they also ask questions about, for example, the return on incremental invested capital, right? So the new investments that have been made. Well, I'm a general guy. I always love to keep things simple and use rule of thumbs. So as Keen said, well, better to be roughly right than precisely wrong. I personally don't use return on incremental invested capital often, but I just look at the evolution of the return on invested capital. And when it increases, well, you know that your return on incremental invested capital is attractive and the other way around. But a really important one. Other thing you want to see, well, very straightforward, I guess, healthy balance sheet. So companies that are in good financial shape, gives them flexibility and so on. And what you also see often is that those companies are so good, they are generating so much cash that they basically have more cash than debt on our balance sheet because they don't know what to do with the cash. They distribute to shareholders via share buybacks, dividends, and so on. And obviously, a healthy balance sheet is really important. Third point we outline in the Art of Quality Investing is the secular trend. So attractive growth, revenue growth, earnings growth, and so on. Because that's also really interesting when you would create a chart with stock prices over time and compare them to the earnings growth over time. You will see that basically in the very long term, well, stock prices always follow the earnings growth. And you both will probably also notice Francois Rochaud has a beautiful table in his annual shareholder letter where he compares the performance of his fund with the owner's earnings of the business. And it's by heart right now, but he does that since 1996, I guess. But what you see is that obviously in 1 year or in 2 years, sometimes there is a discrepancy between the owner's earnings and the stock price. But since 1996, it's almost exactly the same. So it's a beautiful thing, and it shows that, in the long term, stock prices follow the owner's earnings of a company. So attractive growth is very important. And then, the fourth point is an attractive free cash flow conversion. So you want that most earnings are translated into free cash flow. Some people refer to it as earnings quality. So you just calculate it by dividing free cash flow by net income. And what you see, and it's basically out of a book from Jeremy Siegel, Stocks for the Long Run, is that companies that translate the most earnings into free cash flow outperform companies that don't, or companies that translate the least earnings into free cash flow by 18% per year. So that's a huge outperformance. So free cash flow is probably also way more important than net income. It's way more robust when you see that company isn't translating most income or net income into free cash flow. It's poor earnings quality. It might also be an indication about making up the numbers by management and so on. Maybe one side note to make here regarding the free cash flow conversion. You can't look at this metric when a company is investing everything or a lot in itself. So obviously, then the free cash flow is really low because they have a lot of growth capex. They are investing a lot in the business. Take businesses or companies like Copart and Dino Polska, for example. So in this case, it might look unattractive, but actually, those kind of companies are really, really attractive because quality companies are often so healthy, so good that they pour out so much cash out of the business and so profitable that they often don't have plenty of reinvestment opportunities. And an easy metric to calculate this, for example, is when you take your growth rate and divide by return on invested capital, you have the rate or the percentage how much the business should invest to grow at a certain rate. So if a company with a growth rate of 10% and a return on invested capital of 20%, it's 10%, the growth rate, divided by return on invested capital of 20% equals 50%. So this means that they need 50% of their free cash flow to grow by 10% per year. If you have a similar company with a return on invested capital of 50%, you take the growth rate of 10% divided by 50%, that's 20%. So they need to reinvest 20% to grow by 10% per year, and they can use 80% of the free cash flow for share buybacks, dividends, and so on. So the higher the return on invested capital, the less a company needs to grow at attractive rates. And so that's also why Chuck Yeager, for example, said, when you have found a quality business, a great company that can reinvest everything back in the business, well, that's really the golden goose for you. That's really how compounding machines are created. Those companies are very rare, but when you found one, well, hold it dearly, I would say, because it can be a beautiful investment.
And I think what your example there shows is that, I mean, I think there is a reason, and you can confirm this if you want, that you started with the qualitative factors and not the quantitative factors, because some of these things are really difficult to just screen for. I mean, when you need to make adjustments for like growth investments, for example, both in terms of OPEX and CAPEX, you need to do some more digging. And often, I find actually, it's often the case that I don't start with a screener. I actually use a screener more to check like the history of the business. Has this gone on for a long time? Can it confirm my thesis more or less? Because it's often the case that I used to use the qualitative factors first. How do you think about that?
Yeah, I completely agree with you, and I also think like worldwide today there are 60,000 listed stocks. So I always also say to people who are in the community of compounding quality, well, investing is all about saying no as soon as possible, right? Because you can't analyze everything. And that's also that your investment philosophy looks like a bit like a funnel. So you start with 60,000 listed stocks. First criteria you can use, well, always stay within your circle of competence. So you exclude all companies in sectors you don't understand. You exclude all companies active in cyclical segments and so on, like oil and gas, construction, commodities, and so on. And that's how you are making your investable universe smaller and smaller and smaller. So then indeed you start with the qualitative criteria, the mode, pricing power, things like that, saying no. And from the 60,000 listed stocks, maybe only, let's say 10,000 remain. That's when you indeed start to, or at least that's what I do, and it's not the golden truth. That's when you use a stock screener based on the quantitative criteria. And out of that, well, only 250 companies remain. Then you are filtering further for skin in the game. And that's indeed, for example, in my model, well, out of the 60,000 companies, there are 149 in the investable universe. And then I didn't even screen for skin in the game yet. So when you do that, then maybe only 60 remain. And out of those 60, well, 35 or 40 trade at ridiculous valuation levels. And that's how you're trying to build your portfolio. But I think, and that's one of the key things I took away also from working in the industry, I guess, is people are really bright and people are working really hard, working 60 hours, 70 hours, 80 hours a week. And yet, 90% of them underperform the market over time, of the professional investors. And we can laugh with them, but the same is the case for retail investors, right? But what's the reason for that? They think on the short term, commercial incentives, and so on. But also, as an investor, when you want to do better than the market, well, try to be like Buffett and don't try to be like Wall Street, right? And there are just a lot of criteria in the stock market that make complete sense and are very straightforward, I guess, that manage to outperform the market. We talked about skin in the game, for example. Well, you have a study from Harvard Business Review that stated founder-led businesses outperform by 3.9% per year on average. You have Morningstar's White Moat Index that outperformed by 3.5% per year since 2000. So in other words, when you would just have invested in the Morningstar White Moat Index 20 years ago, you bought it in 2000, you sat back and you did nothing at all for 20 years, and you probably would have done better than probably 97, 98, or even 99% of investors. And obviously we are here to talk about quality investing, but multiple roads that lead to Rome. Same goes for when you use a rational approach from value investing and so on, family businesses and so on. So what we are trying to do here is taking a lot of different criteria that on their own should already perform better than the market on average in the very long term. You are combining them. Based on that, you are creating your investable universe. You are creating watch lists that I would say I'm quite comfortable to say that when you keep it for a very long period of time, 10 years or 20 years, that it should be able to do better than the index. And based on that, you are building your portfolio that hopefully should still or even do a bit better than your investable universe. So when you use a checklist approach style of investing, I guess that can be really insightful.
So, you talked about investable universe, and you talked about picking stocks from that investable universe. Do you think investors should actually measure their stock picking abilities against that investable universe?
It's a good question. It's a very, very tough one. I think, for example, what your portfolio does on short periods of time, it doesn't say anything. And for me, I started in October last year with Compounding Quality with an official track record. Well, basically, you can say anything about that performance unless your track record is at least 5 years, right? And we also see that with the S&P, for example. Well, last few years, it has been tough for many professionals to beat the index just because of the performance of big tech. Well, in an ideal world, in the long term, your portfolio will indeed do better than the S&P, will do better than the MSCI World, as well as your own investable universe you created. But I would say, well, for Compounding Quality, the goal is to outperform by 3% per year on average, when the investable universe would do really well and just say over very long periods of time, 3.5% per year outperformance, and the portfolio 3%, just saying something, I would still be happy with that. But obviously, you want to do better than the investable universe. But I always also keep the rule of 3 from Francois Rochaud in mind. Well, one stock out of 3 you will buy will be a disappointment. 1 year out of 3 you will underperform the index, and 1 year out of 3 your results will be negative. So I think that's a beautiful framework to live by, and it's so true. And it's true, the rule of 3, but it's only true when you are a really good investor. So when you are just average or above average, the numbers will be even worse. So it's a great rule to live by, and obviously thinking on the long term, focusing on the intrinsic value instead of the stock price. That's the most important thing. And when you do that, and when your homework is correct, results will follow.
Okay, so now we've talked about the 9 qualitative criteria and the 4 quantitative criteria making up the checklist. Is there any of those criteria that is a really hard stop?
It's a good question. It's also a tough one in the sense that, for example, sometimes people say that a company with a PE of 10 is cheap and a company with a PE of 25 is expensive, right? And to me, that just makes no sense, in the sense that you always need to look at the full situation about the company's fundamentals, the outlook, the healthiness of the business, and so on. Well, for me personally, what is essential is that the company has a moat and that there is a high integrity of management. So when a company doesn't have a moat, I will never even consider investing in it, even when it's dirt cheap, right? And also integrity of management. For example, when a company is led by a manager that has been accused of fraud, just saying something in the past, well, that's always a no-go for me. We already talked about culture, which is the most important thing in the long term. So those 2 things are really important. And maybe to add here, last year I spent a few months reading everything Warren Buffett has ever said and written. There was 5,000 pages. And there were 2 things that really stood out to me. First thing is, Warren Buffett was a quality investor way sooner than most people suspect or think. So he was already talking about it in his annual shareholder letters of 1979 and so on. So 1972 was the year he bought these candies, and then under influence of Charlie Munger, he really started to make the switch from fair companies at a wonderful price to wonderful companies at a fair price. But the second thing that stood out to me and that he repeated over and over and over again, and obviously when you read all the annual letters after each other, you start to see the things he's mentioning over and over again, right? But it's just the importance of management. So you want to invest in people that tap dance to work every day, who love what they are doing. And in some shareholder letters, he's also said the majority of managers of Berkshire Hathaway, they are independently wealthy, meaning that they don't need to work for the business anymore. They don't need to be the CEO anymore if they want to stop. They have enough money for themselves, their family, their grandchildren, and so on. But they just keep doing it because they love what they are doing. It's their baby. And that's something that is really important. That's also what made Warren Buffett so successful. When Warren Buffett states that he's going to buy your business for $5 billion, you know that he will keep his word. And over time, he started to build that reputation. And that's also why more and more people started to approach Warren Buffett themselves to buy their business.
So let's take an easy question then. Taking all these factors together, which in your view is the most qualitative business in the world?
The most qualitative? An easy question, for sure. Well, obviously, first thing, when you buy a wonderful company at ridiculous valuation levels, it can still be very disappointing as an investment, right? One or maybe two companies I really want to own, but I don't own at this point in time because I think the valuation is too expensive, is on the one hand Copart. You both will also know the business really well. It's a great business. Chunk to Gold is an excellent book as well. And the interesting thing is there that they can still reinvest plenty of their free cash flow in organic growth. But even when you add growth capex back to the free cash flow there, it's still trading at rich valuation levels. So if you ask me, might be wrong, might be completely wrong. When a stock will go down 40% just because of valuation, then I will be a buyer, but it can happen when things start to get tough on the stock market. Same goes for Constellation Software. It's an excellent business. Mark Leonard he's an outsider, like William Thorndike would say it. But the valuation is so expensive, and what you also obviously have with those kind of companies, they are so loved by the community that you probably also pay a premium for them just because they are so popular. Everyone knows that Mark Leonard is doing a great job. So those are two companies that are definitely excellent businesses. Same also for Visa and MasterCard, S&P Global and Moody's, for example. But right now I'm all naming companies that I don't own because of the valuation concern. So always be wary about that, I guess.
And it's hard to generalize regarding valuation. Of course, every case is different. But what do you think is a reasonable valuation, and how do you think about it? I mean, you touched upon it, but maybe we can take some more on it.
What you see in the industry is obviously you have those complex Excel templates and so on. But to me, well, like Keen said, trying to be roughly right instead of exactly wrong. So it makes no sense to me to try to estimate the intrinsic value of a company to 2 decimal spaces or something like that. But what I do is I always use 3 models to value a company. One is very short-sighted, but to get an easy or first quick grasp is to compare the forward P with the historical average in this chart. Obviously, very short-sighted because you need to look at what's happening at the company, the outlook, and so on. But second and third things are probably more important: the earnings growth model and the reverse DCF. So earnings growth model is also based on the owner's earnings of Francois Rochaud. You can perfectly calculate your return as an investor. It's always equal to the earnings growth plus the dividend yield plus the buyback yield, and then plus the multiple expansion or minus the multiple contraction. Your return will always be equal to this. And the owner's earnings of Francois Rochaud in the long term If valuation remains constant, it's just your earnings growth plus your dividend yield and buyback yield. So to give you an example, maybe LVMH, for example, while you estimate that the earnings growth will be equal to 12%, the dividend yield and the shareholder yield are about the historical average 2% combined. And then you think the valuation is too expensive, and you think that the forward PE will go from around 25 times earnings to 20 times earnings. Well, when you do these kind of calculations, you get an expected return of around 10.5% for LVMH. And then the question for you should be, would you be happy with a return of 10.5% per year? If that's the case, you should consider looking into LVMH. If that's too low for you, well, look at other opportunities, right? Obviously, and be well aware of that, you always make assumptions about earnings growth, fair valuation, multiple, and so on. But the less assumptions you can make, the better. And that's also why I am using a reverse DCF instead of a classical discount cash flow model. So Charlie said, well, if you want to find a solution to a complex problem, always invert, turn the problem upside down, right? So what you are doing with the reverse DCF is you are using a classical DCF where the upside potential is 0%. So you make no assumption at all. And then you are looking at the free cash flow growth that is implied in the current stock price. I should do the calculations again, but for LVMH, that will probably be around 10% right now. So in other words, the market thinks that LVMH can grow its free cash flow by 10% per year in the years to come. Question to you as an investor in this case is, do I think LVMH will grow its free cash flow by around 10%, by more than 10%, or by less than 10%? When you read the earnings call of Q4, because Bernard Arnault wasn't there in the earnings call of Q1, well, Bernard Arnault said the organic revenue growth will be equal to 9%, and we have some operating leverage, so 9% is exactly in line with what happened over the past 10 years. And over the past 10 years, LVMH grew its free cash flow by around 12 to 13% per year. So 10% is implied in the stock price, and expected free cash flow growth is 13%. So this might indicate that it's undervalued. So always using these three methods, evolution of the forward PE, earnings growth model, and a reverse DCF. And then it's just using those rule of thumbs and trying to be approximately right instead of exactly wrong.
I think we got into that theme with Michael Mobosen when we spoke about his book Expectations Investing, which I highly recommend. And I think it's really underappreciated, this topic around expectations. I mean, some investors, they strive to compound their capital at say 30% per year, while we know that few succeed. And at the same time, we know that most businesses are not able to compound at 15% plus % per year over the long term, meaning you really need to have some turnover in your portfolio to reach the really high returns. And what I'm getting at here is that it's you need this twin engine of a low starting valuation and strong compounding, which is more or less the recipe that Buffett has taught us. With that said, what returns would satisfy a quality investor in your view?
It's a good point, and maybe I should have mentioned that in the previous question. For example, I also never calculate the WACC, or weighted average cost of capital, but I always use a proxy. I always use my acquired return as a proxy for the WACC, and for me that's most of the time 10 to 12%. So I guess the goal is to outperform the market by 3% on the very long term. It's an ambitious goal because not many investors succeed in that, right? But then you should probably indeed be able to return 11 to 12%. So you can use a weighted average cost of capital of 12% for that. And I completely agree with you. For example, this morning I did a reverse DCF for Adobe, and I think that we can all agree that Adobe is a beautiful company. But what was implied in the current stock price when you exclude stock-based compensation is that they should grow their free cash flow over the next 10 years. So 10 years is a long period, right? By 18% per year to return 10% per year to shareholders. So you use the WACC of 10% there. Obviously, those expectations are way too high. and it's something to worry about. It's also, I think I heard it from Mobus in one of his podcasts a few years ago, when you would look at the data and you would look at how many companies succeed at growing 15% per year for very long periods of time, the percentage is really low. And maybe one thing to add here, and that's one of the key things I took away for working in the industry, is I was involved in a rather small equity fund in a broad perspective, so 200 million in assets under management. But even we couldn't even look at a company with a market cap under 10 billion. And a fund of 200 million is peanuts in a global perspective from Wall Street. Meaning that all global funds, they are looking at Apple, Microsoft, Amazon, and so on. And in the large cap space, I just think that also the market is just way more effective. And Warren Buffett said, well, if I would only have 1 million today, I would have no problem to generate a return of 50% a year. And Charlie said, well, I think he's right here. So in general, and that's also what Buffett said, well, go where competition is weak. And where is the competition weak? It's more the small and mid-cap space. And when you're able to really do your own homework there, beautiful things can happen to you as an investor when your homework is correct. And for example, to me, and maybe not the right timing today, but at the start of Compounding Quality, invested in Kelly Partners Group. So Kelly Partners Group is an Australian company active. It's a serial acquirer in accounting solutions with Brad Kelly, who really tries to think and act like Warren Buffett. He is really ambitious. He always says, well, I want to build the Berkshire Hathaway of accounting. By the way, I also think that Brad Kelly was at your event of Red Eye recently, right?
Yeah.
Those kind of companies, they have a market cap of 200 million. And when Brad Kelly would execute on what he's saying that he will do, well, that's indeed plenty of room for upside. And also when the market cap starts to grow, that's indeed when institutional companies or institutional investors might start to get interested. And that even puts a further growth of the stock price because multiples go up and so on. And I think we can all agree, for example, when you have Constellation Software on the other hand, it's a beautiful business. It will grow its intrinsic value per share normally or probably at attractive rates. But there isn't much room for multiple expansion in this case because everyone knows that it's a great business. It's a large business. Track record has been excellent. So indeed, that's when you have the multiple expansion in combination with strong growth. Yeah, that's the beautiful things will happen to you as an investor in that case. That's also how multi-baggers are created. That's how 100 baggers are created. So can be really interesting indeed.
We often term this emerging quality. There might be something missing, but the quality is, they have a lot of quality and it is an emerging compounder, hopefully.
Mm-hmm.
But something you touched upon there that I'm interested to speak a bit more about is the time horizon. Many investors are quite short-term. They say maybe, okay, I'm a long-term investor. I will hold this for the next year. What is your view there and Quality Compounding's view?
Well, I like to say, don't think in quarters, but think in quarter decades instead. So really long term. So any performance less than 5 years doesn't say anything. Also for me, for Compounding Quality, performance has been good since October last year. I think 32% versus 17% for the S&P, but that doesn't say anything at all. So I think the most important thing is to just really think on the long term and have the owner's earnings philosophy in mind. So, for example, I thought about it a lot, and in an ideal world, I just wouldn't report about performance and only do the 5-year rolling performances or even longer. And just look at the owner's earnings, so the earnings growth plus the dividend yield. And when you have your portfolio and the owner's earnings grew by, let's say, 12% this year, and the stock prices came down by 5% or even more, well, it's a beautiful thing, and you know that the companies you own performed really well, and that they became cheaper, so it might be attractive to add even more to those kind of companies. And just looking at the stock prices all the time, it results in making more decisions, more investment decisions, doing more transactions, and so on. And we all know that it harms your results. So the best investor is a dead investor. It's a famous saying, and it's actually true. So just not trying to look at the stock prices daily and really focus on the long term. I think that's a beautiful thing. And that's also what I like about quality investing so much, and what is one of the fundamental differences between value investing, for example. When you are a value investor, you try to find a cheaply valued company. So you think the valuation is too low, and you buy the company, and then hopefully the multiple goes back to the fair valuation level, right? And when that happens, well, obviously the company is fairly valued. It isn't a wonderful company, so you should sell it and try to reinvest that money in another undervalued company. And you do that again and again and again. And that's a difference compared to, for example, quality investing, because quality investing, wonderful companies at a fair price. So when you did your homework and you bought the company, and your homework was right, your investment thesis was right, the company will keep growing its intrinsic value at attractive rates of return. And then you basically don't need to sell the business. You only need to sell when your investment thesis was wrong. Opportunity costs, right? Life is a game of opportunity costs. So when maybe indeed valuation became so high that you found more attractive opportunities in another company. But when the intrinsic value keeps growing of those kind of companies, well, you can use a buy and hold approach. And that's something you can do with growth investing or value investing and so on. And that's also why I think that quality investing might fit so well with a lot of investors when you want to invest in individual stocks.
And if we go in a bit more on your journey with compounding quality, we got to know you some time back on what was then Twitter, now X. Mm-hmm. How would you describe what you are doing and how the journey has been so far?
Yeah, so compounding quality started in June 2022. So 18 months, a bit more. And it was just for fun. And you both might also still recall that in the beginning, I was really cautious about sharing my identity. I really didn't want to be seen and keeping everything anonymous. But since last summer, I quit my job outside the industry. And that's also where I felt like people had the right to know who I am, because there are people who aren't very honest in the industry, who have commercial incentives and so on. And there are a lot of people who have had a bad experience with these kind of things, right? So I felt like it was really important and people had the right to know who I am. So that's also why I shared my identity and so on. And when we look at compounding quality right now, I guess active on LinkedIn and X mainly, sharing what I think about the market, interesting snippets of things you read and so on. So that's one part. And then you also have the website, Compounding Quality, with almost 240,000 email subscribers or readers. And there you have a part indeed that talks about the philosophy, like The Art of Quality Investing, the book, for example, does. And also a part where you can see investment cases of companies like MedPace, of companies like Kelly Partners Group. You can see my portfolio and so on. So the philosophy there is simple. Well, just like you, investing is your passion, it's your hobby, it's in some part your life. You love what you are doing. So I try to put my entire soul into the website. And also there, honesty, integrity, really important. So I also felt like some people stated to me, when you are doing something like this, you shouldn't share your portfolio, because by definition, active investing, you will underperform from time to time. And everyone who's saying that he won't or she won't is lying, right? So they state, don't share your portfolio because it's a dangerous thing. And when things start to get tough, that people will get mad at you and so on. And I agree with them. But also the other part, for me, there is some part is behind a paywall for compounding quality. And when you ask money for something and you aren't sharing everything with 100% transparency, and you aren't even willing to share your portfolio because maybe it doesn't outperform the index, for example. When that is the case, you shouldn't be asking money for what you are doing at all, and you should go fishing or golfing or whatever you want to do. So that's why I felt that people have the right to know who I am, people have the right to know where I'm invested in, and also all my investable assets are in the portfolio. So when I do well, you do well, and the other way around. So when an investment pick doesn't turn out to as well as you expect it to, which will happen from time to time, then you are also in it with all your partners or readers together. So I think that's something that's really important in this case, to just be honest, transparent, and that's what maybe some people in the industry are still missing today.
It's really impressive how you have built up this huge following. And I'm curious about, I mean, you're publishing a lot of content as well. How do you organize things? Do you have any help from someone else, or how is that working?
Right now, I'm still doing everything on my own. I have one person, Daval, which I'm really grateful for, who's sometimes helping with creating designs on LinkedIn. So, for example, return on invested capital, that I provide him with text, and he tries to bond it in a beautiful looking visual. It's also a journey of entrepreneurship, and that's completely new for me. So been doing this for a few months right now. Obviously, for example, last week with the book launch, I worked all week from 6 a.m. till midnight. That's not something that's sustainable, right? So over time, probably we'll look for people who are as passionate as investing as I am, and who really want to work on a beautiful project together and to grow. But right now, the majority is done by me. And that's also maybe something a lot of people are asking that, and then you're working long hours and so on. But the only way you can do that is to be passionate about it. And that's not just for investing, I guess. It's for whatever you do in life. When you are passionate about something, you will probably do it better, and you also, it will allow you to keep going when things start to get tough from time to time. So following your passions and doing that is probably, some people will disagree, but I guess it's a good life advice for people to follow.
It's great that you can combine the investing passion with your interest in teaching, and I'm sure that many people are happy about that. So where do you want to take this if we look ahead a number of years, say 10 years? Do you have such an ambition?
It's a good question. Think most important thing, or two very important thing, is one, having fun, and two, indeed trying to provide as much value as you can to readers and to the community and so on. I think that's the most important thing. And regarding compounding quality, the newsletter is there right now. Also considering to launch an equity fund based on the philosophy. That's something that might be possible in the future, but it all depends. And it's also, I think, the wisdom of crowds is a beautiful thing, and just asking the community what they want and listening to them. And I always mention readers of compounding quality as partners, as we're in this together, just to try and build a powerful community and a powerful website, and who knows, a fund. I think that's the beautiful thing for the years ahead, hopefully.
And this quality first mentality that you have in investing, does that apply to other aspects of your life as well?
Should I give the honest answer, or the answer you want?
The honest answer.
I think it does, and like many quality investors, I also start as a value investor right now, and that's also something I start to learn. In some sense, and my girlfriend doesn't like it. You are an investor. You don't like to spend a lot of money, right? So some people will maybe say you are a bit frugal, but also sometimes, just like on the stock market, it makes sense to pay up for quality, because then the longevity and so on of the product is way better. So I think that also is true there. So quality is something beautiful, and Warren Buffett even started focusing on it in 1972. And if even he does, or even he did and is still doing, well, it also can make sense for us to do the same, right?
And the endeavor that you're on right now, I mean, it's really a lot of work. You thought a lot about how to do it probably before you actually committed to it full force. Do you have any techniques or habits that you find helpful in the daily life within your project, but also as an investor?
I think that indeed what really helped me is when I started compounding quality, it was just for fun, but I was probably working around 60 hours a week from a regular job. And that just forced you to use clear frameworks to optimize everything as much as possible, optimize your time. And I think that's really helpful. And you probably also know the books of Cal Newport, Deep Work, Eat That Frog, and so on. And I also truly believe that just by being really concentrated about something without being distracted, that's something that improves your productivity dramatically. And right now, I always structure my day exactly the same way. And that's probably the only way to make it work. And that's how I do it every day, is from 5 a.m. till 7 a.m. reading. So reading books and so on to improve your knowledge, maybe summarizing them for compounding quality, the community, and so on. Having breakfast, then from 7:15 till 9, usually reading at least one 10K a day. And then from 9 to 12 or 9 until noon, working on investment cases, analyzing stocks, still diving deeper in 10Ks and so on. And then 12 till 1 p.m. I try to run and listen to an earnings call and so on, not achieving that every day. And then the afternoon, because I'm an early bird, the afternoon is a bit more light work. So early afternoon, working on articles, but not on full investment cases. And then late afternoon, indeed, social media, podcasts like we are doing right now. So doing things like that. But for example, when you wake up at 5 a.m. and you work until noon and you just don't touch your phone until noon, that's probably amazing that you how much work you can get done. And compared to when I left the industry, for example, then you were at least in some way obliged to answer to emails when your boss sent you one, right? And just having the being in the luxury position to say, okay, I only check my mails once a day. It's 5 p.m. for 20 minutes, and that's it. Just that it allows you to increase your productivity dramatically. But regarding this subject, I guess the book Deep Work is also an excellent read.
And ending on that great subject of books, as this is a book podcast, we always like to wrap up with questions about reading and writing. And we know that you are a book nerd as us. I mean, you followed us from the start, and I guess that comes from your curiosity and passion with investing, but also with reading. Are there one or two timeless titles that you think stand out?
Regarding the investment field?
Maybe focus on investing. We can take other titles as well, but start with investing.
Yeah, I think two books I really like, and apologies for that because they probably already were mentioned a few times, is The Joys of Compounding and Richer, Wiser, Happier. A book I started reading this weekend, and probably you guys have already read it, but I think it's really refreshing, is what I learned about investing from Darwin. So those are three books I would definitely recommend to everyone. But in general, obviously, also already talked about it. It's also on my website. Just reading everything of Warren Buffett it's tough. It's 5,000 pages, but you will learn way more than whatever study you do, whatever book you read, and so on. And that's also what I try. I'm just like you guys, probably a big nerd in that, and I compiled on the website also 600 to 800 PDFs from Buffett, from Munger, from Lynch, from Templeton, Lilu, and so on. But just reading those kind of things is also good. And for example, when you also read about financial crisis or the Great Depression and so on, and just to keep some of those articles in your office and taking a look at them regularly can help you a lot, because we all know, not sure when, nobody knows when, but in the future there will come a time that the stock market will go minus 30%, 40%, 50%. It's probably really important to be aware of that and to mentally prepare yourself against that. And when this happens, I think it can make a lot of sense, or it will help, at least it will help me a lot to hear or read that Buffett says that he's in the financial crisis, that he's like an oversexed man in a harem and things like that. Well, that those kind of things help to stay rational when things start to get tough.
And to invert the question a bit, is there any book that you wished was available but you haven't found?
Ooh, that's a tough one. Probably maybe there is a book, but I don't know of, is that a book that is indeed about a journey of an investor and all the investment mistakes he has made or she has made. Because every investor who picks or invests in individual stocks will know that we all have made plenty of mistakes, and it's way better to make a mistake with $1,000 than with $10,000. But some mistakes can be avoided by learning from other people's mistakes. So I guess that would be a book that I would love to read if it's available somewhere.
It's a great proposal for anyone listening to the podcast to start on that book journey.
I think we can recommend Daniel Zhang's book that we talked about quite early in the podcast history, an investment thinking toolbox. Then he goes through his investments and he mentions many of his mistakes that he was doing at the time, and it's written chronologically. So I think that's that one to start with.
You just made me order a new book, so I'll order that one right after our conversation.
Perfect.
And Daniel, if you listen to this, we don't need any royalties for that.
Pieter Slegers, thank you so much for coming on Investing by the Books podcast. Talk about your journey and the art of quality investing and much more. Do you have something more you want to add here before we finish up?
Thank you. Yeah, first thing I want to say is just thank you very much for the opportunity. And for those listening, I would say, just always keep evolving, keep learning, keep reading books. And I think that's the best investment you can possibly make, right? And it would be very naive to say that the investment philosophy and investment strategy we use today will be exactly the same in 10 or 20 years from now. So keep open-minded. Let's keep learning from each other. And what you guys are doing with the podcast, and to learn from excellent books for free, basically, via the podcast, I think that's an excellent or a lovely thing to do. So I also see you both as teachers in some way. So thank you very much for that.
Wonderful. And lastly, where can our audience follow you and your work?
Obviously, we have the Art of Quality Investing, which is available on Amazon right now. And I'm also available on Twitter or X on Compounding Quality, LinkedIn under my real name, Pieter Slegers, or via the website compoundingquality.net. So happy to connect with investors and to learn from each other.
Thanks a lot, Peter.
Thank you so much. Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmgren, and until next time, I sincerely wish you the best of luck on your journey through life and investing.